Hello and welcome to our Part 2 training on Pay-as-you-earn. This course is presented by Kagiko Associates. My name is Blessing. In our Part 1 training, we looked at the foundation of Pay-as-you-earn. We also in detail looked at various types of employment income subject to Pay-as-you-earn. In addition, we looked at how each income derived from employment is treated for tax purposes. Also, we looked at the allowable deductions against employment income. This training builds on concepts already trained in Part 1. If you have not watched Part 1, please follow the link in the description below for the previous training. In today's training, we will cover reliefs allowed against Pay-as-you-earn, how lump sum payments, like gratuity, are taxed, penalties for non-compliance with Pay-as-you-earn rules, and most importantly, how to make a Pay-as-you-earn return on iTax. A distinction needs to be made between a tax relief and an allowable deduction. An allowable deduction reduces taxable income, whereas a relief reduces tax payable. Consequently, as of now, Kenya Revenue Authority only provides two reliefs against employment income. These are personal relief and insurance relief. Personal relief is currently set at Kenya shillings 2,400 per month or Kenya shillings 28,800 per annum. Personal relief is not available to non-residents. On the other hand, individuals servicing insurance policies related to life, education, or health insurance policies are entitled to an insurance relief equivalent to 15% of the premiums paid for self, spouse, or child insurance policies. The maximum allowed insurance relief is Kenya shillings 5,000 per month or Kenya shillings 60,000 per annum. Sometimes, employees receive employment income in a lump sum. For example, a payment for gratuities, bonuses, severance pay, etc. These incomes are earned in the course of employment and accrued for payment at a given time, usually at the end of employment. The Income Tax Act provides that, if you receive income in a year different from the year in which it was earned, that income is to be considered income for the year it was earned and taxed together with other income earned in that particular year. Let us look at an example. If an employee is paid 222,000 Kenya shillings, made up of Kenya shillings 22,000 of gratuity per year for 6 years, and Kenya shillings 90,000 notice pay in year 2023, then the total payment of 222,000 Kenya shillings will be spread on the year it was earned and taxed on that particular year. The tax payable will be the difference between the tax payable when the income for each year is aggregated and that year's income tax rates are applied. Then, less the tax already paid, since this was in the past. On the other hand, when the contract is for a specified term, and a payment is made to compensate the employee for the unexpired term of the contract, the amount received is considered to have been earned evenly and is assessed over the unexpired period. The amount so paid is spread forward and taxed at a rate equal to the rate the employee's gross pay per annum is taxed at, immediately before termination. For example, if an employee is paid Kenya shillings 500,000 in year 2023 for termination of contract whose remaining term is 5 years, then the payment will be spread for 5 years into the future and taxed in the current year's tax rates. Note that future relief can be applied against tax for now, but relief can never be applied twice in the same year of income. Similarly, if the term of the contract is not known, then the lump sum will be spread evenly for 3 years and taxed at the current gross salary rate as shown on this table. We will revisit this when we file the pay return on iTax. Employers are obligated to withhold, file and pay-as-you-earn by the 9th of the following month. Failure to deduct pay-as-you-earn attracts a penalty of the higher of 25% of the tax in question or Kenya shillings 25,000. It is not enough to file pay-as-you-earn by the 9th of the following month. Employers have to make payment of pay-as-you-earn due after filing in iTax. Failure to pay on time will attract a late payment penalty of 5% of tax due and 1% penalty per month as long as the tax is outstanding. Last but not least, any employer that makes salary or wages payments to an employee who does not have a PIN will be liable to a penalty of Kenya shillings 2,000 per month. And that was the end of our Part 2 training on Pay as you earn. In this lesson, we have looked at various types of reliefs available to employees under the Pay as you earn regime. In addition, we have looked at how lump sum employment income is taxed. We have also looked at the allowable deductions against employment income. Please look out for our next lesson in this series that will cover how to make a pay-as-you-earn return on iTax. We appreciate you for watching this video. Please give us your feedback by commenting. While you are there, don't forget to like and subscribe so that you don't miss the next parts. You can find us on LinkedIn, Facebook, WhatsApp, Instagram and Twitter under the name Kagiko and Associates. Kagiko and Associates. True and fair.